Hello, everyone, and welcome to episode 72 of JustDario Cigar Time. I'm recording this episode as the ceasefire between the US and Iran nominally remains in place. But nominally being the right word because if I'm to stay intellectually honest, I'm not sure a ceasefire was ever in place in any meaningful sense. Considering what happened on Wednesday, shortly after it was announced, we saw attack on Iran oil infrastructure, followed shortly after by retaliatory attacks on Kuwait and even the east-west oil pipeline in Saudi Arabia that currently carries 7 million barrels of oil per day that are so far successfully exported through the Bab el-Mandeb Strait. This attack so far that has been, let's be honest, watered down quite a bit by mainstream media coverage, with the full extent of the damage still unknown. I personally agree with what General Kane said at Wednesday press conference. This ceasefire is a pause, nothing more. And frankly, it's painfully obvious that every party in the region has its finger on the trigger and is ready to pull it at any moment. Assuming this nominal ceasefire holds through the 18th of April, that, in my opinion, is the best case scenario, with no final peace agreement, but at a minimum allowing the liquefied natural gas and oil tankers stranded in the Strait of Hormuz for the past 6 weeks to begin moving, what we're about to witness is the oil market heading toward an event horizon that, remarkably, very few people seem to be aware of. The date is April 21st, 2026, and I'll explain exactly why it matters. Before we begin, like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. Tuesday, April 21st, is the day the WTI oil futures contract for May stops trading, with the June contract becoming the new front month. Why does this specific window matter so much? Because everyone currently holding positions on that front month contract is rapidly running out of time to make a very consequential decision, and there are only 3 options on the table. Option 1, close the position. Option 2, roll it into the next June expiry. Or option 3, hold it to maturity and stand for settlement. The pressure is squarely on the shorts. This is where I want to focus specifically, because those currently short on front-end contracts objectively are under far more pressure than longs. And here is why. If they don't want to issue a delivery notice, risking to default at settlement if requested to settle physically and not in cash, they have no alternative but to buy back the contract. And the mere act of buying back those contracts before expiry will mechanically push prices higher, relentlessly, toward April the 21st. Now, in theory, there is a second option. Buy back the May futures shorts and short the June contract simultaneously, which should push that contract's price lower. But here is where it gets complicated for those short positions. Due to the very steep backwardation in the market, simply rolling that contract is effectively the same as selling high and buying low. Current price levels, those traders are looking at a premium cost of roughly $9 per barrel, approximately 10% of the current nominal price. And there is yet another factor to layer on top. Where are spot price trading relatively to futures? Currently, spot prices on physical crude are between $30 and $50 above the front month May 2026 WTI future, depending on the market. And the closer we get to the contract expiry, the greater the mechanical pressure for those two price levels converge. So here are the three scenarios. Scenario 1, spot prices come down while futures move up, and on a net basis, they meet in the middle. Scenario 2, spot prices collapse toward the future price without generating significant additional upward pressure. Scenario 3, spot prices hold where they are, or even increase further, and futures are forced to converge upward towards them. This is not a matter of debate. It's mechanically imposed by how the arbitrage system works. At the moment, scenario 3 is the most likely one, objectively. Why is scenario 3 increasingly probable? Because given the level of supply destruction that has persisted over the past 6 weeks, there is simply no realistic path for the oil tankers stranded in the Strait of Hormuz to reach their destinations by April the 21st, even if the strait is fully reopened today. By the time that May 26 contracts expire, there will be a structural shortage that cannot be filled, regardless of what happens afterward. This creates a massive problem, a gaping disconnect between physical supply, availability, volume of futures contract standing for potential delivery. In a normal market, prices will simply grind higher, allowing spot and futures to converge naturally. But we had another massive taco-driven shock that triggered a broad market flush, and frankly, every professional trader I've spoken to has been left baffled, because by any rational measure, it's completely nonsensical. Sure, speculative longs might get flushed out, but the core of those standing for delivery, attempting to source through the futures market the physical supply they can no longer obtain directly, those positions will be sticky right through the expiry. And here there is one final element that allows me to draw a direct parallel with the events of April 2020, which paradoxically unfolded in exactly the same calendar window. If you remember, at that time, governments were assuring everyone that lockdowns would be temporary, the economic impact would be minimal, and everything would normalize quickly. Many traders were long oil because they failed to appreciate the sheer scale of demand destructions that lockdowns were actually generating, misled as they were by the prevailing narrative. And that ultimately culminated in the historic crash in oil prices that ended the session at a negative print. I won't rehash that scenario. I've covered it extensively in previous episodes. But what I want to stress today is how powerful a misleading narrative can be, even as we approach an inevitable moment when reality can no longer be ignored. And the reality is this: futures are completely mispriced, particularly on the shorter end of the curve. So, while 2020 saw oil volatility spike to over 500 points in that event, I believe the probability of something similar unfolding again is far from zero. At some point, traders will begin looking to net their position and confront an oil market where, at the current price level, there is virtually no offer. As Bloomberg reported, for example, 12 bids for Brent crude tankers currently on the water received no offer at the current prices. So that is when people might start to panic. And I don't want to miss the opportunity to warn everyone again. Prepare for a volatility spike, and that spike will inevitably reverberate through the entire financial system. A financial system that, as you have just observed, remains stubbornly bullish, ignoring everything that is happening, ignoring the shifting balance of power across the Middle East, ignoring the long-term economic damage that is about to manifest in the daily lives of people across the globe. Thanks for listening to me again today, for supporting me on X on Instagram, and for reading my research on JustDario.com. I wish everyone a great day.